Welcome back folks, this is Donkey Capital with another top-down analysis. First of all, I want to thank you all for the support. Don't forget to subscribe and like the video if you are enjoying my content. Let's start. First, I'm going to introduce you what I used to know where the market was going. Here you have market structure. We can frame trades by using market structure. Basically, we study how highs and lows are formed. If we see that price creates a low near or at a higher timeframe PD array, we must pay attention to the next lows. If price starts printing higher lows and higher highs, creating what we know as a market structure shift, then we can start looking for long setups, as you can see on this example. Let's start from the daily chart. To put you in context, we had made a new all-time high. When this happens, you should not be interested on trying to pick tops or bottoms. Therefore, I was bullish. Having that into account, we had a daily bullish order block, so I noted it, since price could use it to keep going higher as it did. 4-hour chart. Well, here we have another confluence to make us think that our bias was bullish. A 4-hour fair value gap that was beautifully filled when price traded into the daily bullish order block. You should start adding confluences in order to know that your bias is right. 1-hour chart. Here we have another confluence, an hourly bullish order block near the low of the 4-hour bullish fair value gap. Plus, if you look to the left, there was a sell-side liquidity pool raid when price took that low. So, we already have a daily order block, a 4-hour FVG, an hourly order block and a sell-side liquidity raid telling us that price wants to go higher. 15-minute chart. Here we start to see some smooth highs that we can use as targets. You can also see how price went down to fill those imbalances, engage sell-side, and to reprice into the order blocks. Basically, we use this time frame to get a better view of where price might go to. In this case, we have the smooth highs. However, we will focus our attention here. In this pink shaded area, when we drop down to the 1-minute chart, you will see how price trades. Since those wicks on the 1-minute chart show a beautiful market structure shift. 5-minute chart. On this time frame, it's even easier to frame relative equal highs or lows. And as you can see, that buy-side liquidity pool was really juicy. But, if you look down, you see how choppy price traded when it got down into the order blocks and into the sell-side liquidity pool. Why is that? Because smart money was accumulating long positions there. Remember that we were inside of a daily bullish order block. So you have to know that in order to not get frustrated. 1-minute chart. Well, here you can clearly see in a real chart the graph that I showed you in the first slide. I invite you to pause the video and try to note what you see. Okay, now that I've added some lipstick to the chart, let's start explaining. The first thing that we see is that we had rated sell side, so I was waiting for a market structure shift in order to look for long setups. When price touched the hourly order block, it started to move to the upside, right at 9:30 a.m. New York local time, creating a market structure shift with a 2-minute fair value gap that it's not shown. Then price retraces into that CISD, which means change in the state of delivery. It is the first order block in a market structure shift. Then price inverts a fair value gap and creates a new high, leaving behind a nice FVG that will act as our AM session silver bullet. Price spends some time inside of it accumulating long positions and then starts going to the upside. If you look closely, right before the move to the upside inside the silver bullet FVG, price swept a low and created a high, forming a 2022 model with an FVG. That fair value gap is another silver bullet, and this is the one that I took with my funded account. And it is also the last fair value gap before 10:30 a.m., the time when price started moving straight up. Lastly, another confluence that we had to frame a long setup, is that we had an opening range gap to fill, as you can see. As I've already told you, opening range gaps tend to be filled, so you should take them into account in order to frame a bias. Now, I will show you some possible setups and their respective risk management using what we've seen on the video. This first setup is an inversion fair value gap entry. I took this with some of my evaluation accounts. It paid quickly. You will enter as soon as price closes above the fair value gap range and your stop must be below 3 PD arrays or below the inversion FVG low. In this case I had the inversion FVG consequent encroachment, a volume imbalance and a bearish candle protecting my stop, and it offers a solid 1-to-1 risk-reward ratio. The next setup is the silver bullet FVG. As you should know, the stop goes below the low of the candle that creates the fair value gap, and in this case our target would be the buy-side liquidity pool. If we took this setup, we would have to sit some time in drawdown, but with sound risk management there is no issue for that. And this setup offered a solid 1-to-3 plus risk-reward ratio. You could held for the last buy-side liquidity pool, but you would have to endorse a retracement. And our last setup is the last silver bullet that I showed you. Following the silver bullet rules, this setup would have offered a solid 1-to-5 plus risk-reward ratio. In my opinion, this was the best setup of the session. Even though it suffered some drawdown, it ended up paying well with a straight move to the upside. Partials could be taken at the opening range gap high or at the 4-hour FVG high. Well, if you have made it to the end of the video, congratulations and thank you. I'm sure that you are making some progress and putting the effort needed in order to succeed. Do not forget to subscribe and like the video if you learned something or appreciate the effort put in the videos. Until the next time, be safe.